Do you think indexing has gotten too big for the market?
I don't think indexing by any stretch of the imagination has gotten too big for the market. You always see these sort of comments in the media about how now there are more indexes than there are stocks, which just is ridiculous to me because no one sort of, gaffs at the fact that there are more colors than primary colors. Indexes are just a way of recombining individual securities. So there are inevitably going to be many variants, even of seemingly like benchmarks, if you will. So I don't think indexing in terms of an investment approach either has gotten too big for its breaches. You measure it either by assets, which I don't think is necessarily the right way to measure it. I think more importantly is you measure it by the amount of sort of trading activity that goes on across the globe in global equity markets. I think we're far from the day where the tail is wagging the dog, as many seem to want to claim. At some point, we may reach that point where the tail is wagging the dog, where markets are in some way going to become less efficient or in some way inefficient, given that more and more investors are opting to index their portfolios. And at that point, the pendulum will inevitably swing back in the other direction. So I think the fears around all of this are somewhat misguided, somewhat overblown. I think indexing has a very long trajectory yet to cover before we reach a point where it's indeed gotten too big for its breaches.
Given that, where do you see kind of the trends in the index industry? Where do you think we'll be in 5 to 10 years? Or what areas do you think will be brought out in that kind of time frame?
Well, I think the most important trend that gets the least amount of attention, the least amount of ink, is the one that's been in place now since the mid-1970s, at least in the US, which is just the growth of the most broad-based, the most traditional, plain vanilla market capitalization weighted index products. These are the basis for the most all-weather portfolios that anyone could possibly imagine. They're broadly diversified, they're very low cost, they're very tax efficient, they're very easy to use well because investors understand going in that they are going to get the market return, however that market may be defined. So I think the trend is going to continue, that most of investors' money, that most of their time and attention, which I say most, but it actually is a way of reducing the amount of time and attention you have to spend worrying about your investments and your portfolio, is going to continue to go where most of the assets are, quite frankly, today, which is to very broad-based market capitalization weighted indexes and the funds that track them. And that, I think, is inarguably a very good thing for most investors.
Right. Ben, with the increasing number of products out there that have titles and names that sound a lot alike, what is your view on investors understanding methodologies that are behind some of these rules-based products?
It's absolutely critical. So in our Morningstar analyst rating framework, we look at 5 pillars or 5 Ps. And in the case of index funds and ETFs, the P that matters most, if not more than any other, is process. And in the case of index tracking portfolios, process is defined by the index methodology. So it's absolutely critical, especially given the growth, as you've described, of similarly labeled strategies, to be able to parse all of the various nuanced differences amongst what at face value one might expect will deliver very similar risk-adjusted returns over a long period of time. So to understand the differences in selection criteria, in weighting criteria, rebalancing treatments, any constraints that are on the portfolio with respect to sector exposures or unintended factor exposures. There are any number of different criteria that investors need to be able to understand, and not just understand at face value, but more importantly to understand what are the implications of all of these nuanced differences with respect to what they can expect from the fund they're investing in as it pertains to the return profile across various market cycles of that portfolio and the risk profile of the resulting portfolio. Because as you can see, if you were to take, say, a half dozen similarly labeled value strategies, for example, is that if you look back over a 3-year period at a risk return plot, what you get is something that does not look like a rifle shot, but looks more like a shotgun spray. That the outcomes that you get are very disparate from, again, what at face value you would expect to be otherwise substantially similar.